Hello, everyone, and welcome to this day's major markets update for February 25, 2022. Is major 4 complete? Yes or no? I have some technical difficulties with the sound, and we should get started pretty soon. Let me see what is going to happen here. I'm going to continue for now. I'm going to get some chat feedback. And the question, of course, is the major 4 low in, yes or no? I think the major 4 low in is in, so we can get started right here, right now. First and foremost, let's go back in time a little bit. Here is an article I posted today about the S&P 500, where I showed that already since March 24th, February 6th, sorry, just too much going on with the chat. I was looking for 4150 plus or minus 50. We got 4115. So my conviction remains that we have bottomed for this move lower. This is then the Nasdaq 100 update I posted for investing.com, where I showed that since June last year, I was looking for a rally to 16,000, a drop to 14,500, and then a rally again. Those are, of course, wave 3, 4, and 5. We got 16,800 in November, pretty good. We got 13,100 yesterday. Not too bad, considering this is since June last year. It always takes a little bit more data to refine such a forecast. And then 17 to 18,000 for the rally that's now coming, maybe even to 20,000. So I remain convicted that we have a fifth wave left to go. I showed you that already last Friday. All these, on several of these international indexes, as well as other US indexes, require a last fifth wave. And I will show you it again. So here we go with the Nasdaq. The Nasdaq has, in my humble opinion, completed a regular expanded flat. Regular because the B wave topped almost close to the all-time high, 5 waves lower. And this was wave 4, no overlap here, 1, 2. I was looking here for this gray wave 3 on Wednesday, a 4 and a 5. It seems like the market gave us all of 5 on Thursday already. That then means that Tuesday was the 3 and the 4. The 3 and the 4 is stuck in here in this day. It was like an up-down day, up-down day. And what matters is that we reached the ideal target zone for wave 5 in gray, of wave 5 in green, of wave C in red, of wave 4 in black. We've done enough, as you can see here. We have retraced all of this extended wave 5. We bottomed for intermediate 4 in March last year, and we've simply erased a 1-year rally. And that's quite typical for a 1 degree higher fourth wave to do, to fall back to the previous fourth wave. I've shown it many times. Let's zoom out. Here is the weekly chart. 1, 2, 3, 4, 5, right in the target zone. As you can see, it nailed the lower end, C of 4, bullish reversal candle, looks good. Also here, you can see here is the wave 4, extended wave 5, nicely subdividing. No worries here, it looks good. And of course, the negative divergence will continue. Wave 5 should then top 18 to 18,500 ideally. Here is the Dow Jones. Right? The Dow Jones I had should bottom here for wave 3, then a wave 4, then a wave 5. It is still possible for a 4 and a 5, but I prefer this as a wave 5 of C of 4. In the meantime, I have readjusted the wave count, as this is then a, I would call zigzag, ABC. This is likely let me put that in a little better here. So this would then be wave 1, this would then be wave 2. And again, the closing prices don't always work exactly. This is then wave 3, and this is then wave 4, right there. So this is then wave 5, and then this is 1, and then this is 2, right there. And then the same here, we got wave 3 there. And it's simply a resolution that I sometimes don't always. Wave 4 right there, and then this is 5. Why? Again, look at where wave 5 should bottom. It should bottom right there. Right there. And that is what we got, and that is what matters. And look at now, this one of the strongest rallies we've seen in a long, long time. This looks good. We have this positive divergence right there. We have not so much positive divergence here, but we do have here. So this is actually still confirming the lower low, but that is fine. Money flow is definitely good. So I like this, and it looks like the Dow Jones has also completed its correction. Moving on to the Nasdaq. Here I'm going to go over several wave counts to see what the wave degree was. I've shared this one a while ago to show you that this cannot be a wave 4 of a wave 3 of a wave 3, meaning there would be 2 more or 3 more up legs to go, a wave 5 or 4, a wave 5 and 4 and a 5, because we have strong overlap. So this cannot be the correct wave count. This is the whole idea of this little exercise here. I'm going to show you 3 charts that will show you which wave count is most likely correct. Here's the March 2020 low. You can count it as 1, 2, 1, 2, 1, 2, 1, 2, and then 3, 4, 3, 4. Can't be because we have overlap. So this one gets dismissed. Then we can say, okay, we do 1, 2, 1, 2, and then 1, 2, 3, 4, 5, and then we again have overlap. So it can't be this wave count either. Okay, this is just simple elimination. And then what we're left with is this wave count, in my humble opinion. 1, 2, 1, 2, 3, 4. And no, this wave 4 missed wave 1 by a couple of dollars. Perfect. 1, 2, 3, 4, 5. This is the extended wave 5. Doesn't surprise me. This QE-driven market has often had extended fifth waves, because in this case, the third wave was a doozy. And then the fifth wave will do the trick. And if this is the low, we have not retraced with wave 1. We had a shallow wave 2, and then we have a big complex wave 4, rule of alternation. This was a zigzag wave 2. This is then a flat wave 4, as I showed you with the regular Nasdaq. And we have so far no overlap. 12,500 was the must-hold level for the bulls. They're doing it. I like this wave count. This is my preferred wave count to show you objectively, so to say, by simple elimination, which wave count is most likely. Are we going to see 2 more legs higher, 3 more legs higher, or 1 more leg higher? Looks like 1 is the answer. Then I'm going to zoom out. This is the Nasdaq 100 weekly chart, just as I showed you for the Nasdaq. 1, 2, 1, 2, 3, 4. Extended wave 5. Look how deep this wave 4 is. Normally, it bottoms at 38.2% retrace of all of wave 3. It didn't. One of the reasons is because of this extended wave 5 in red. This one was very extended. Now you see here the loud and clear A, B, and the 5 waves, wave C. It is actually quite a nice filled in pattern. So here we have wave A of wave 4, and here we have wave B. Sorry, that should of course be no, in red. Yes, there, wave B. And then we have, of course, the subdividing waves of the wave C. This is 1. Okay, this is 2. And then this is 3 as well. So working out really nicely. 4. And this is 5. Okay, 5 of C. Perfect. And while I'm working on here, remember, for example, I've seen many analogies with many corrections going back to the 1929, 1930s market crash, to 2020, 2018, 2015, 2007, and 8, all of them. And there is plenty of overlap with the current correction and the previous ones. Why? Because corrections always move in threes, ABC, right? ABC can be exhibited in several patterns, a flat or a triangle or a zigzag, but it's always kind of like a similar type of setup, ABC. The lead-in is 5 waves higher. So the lead-in to the 1929 top was 5 waves. Same for 2011, 2015, etc., etc. So that's why those analogies always work, but eventually they fall apart, which is the fractal nature of the markets. The fractal will hold because we're following and tracking a correction quite nicely. And that I posted on, for example, here, FX Empire. I was tracking this correction quite nicely, and eventually the fractal will fall apart. Let's have a look here, which chart am I at, not this one here. And we should have completed wave 4 and now in wave 5. I see no reason to change my tune. The bears have to be very careful once we start, of course, overlapping with critical levels. Right here, 15,035 is a very critical level, and here as well. Okay, these are the critical levels to watch. Let's look at small caps. Also, the small caps want to see another leg higher. This is going back all the way to 1995, 34345, cycle 1, cycle 2. We completed cycle 3 and cycle 4. At least that's the way I've labeled it. And we should now be in cycle 5. I've not changed this chart at all. I've had this chart for, the only thing I changed was actually the width of the chart, from 1280 pixels to 1600 pixels, so to say. And this looks like a very nice wave 3 top right here at 116.8 extension, almost back to the 100% extension, and then we should get away from it. This looks picture perfect. I'm just looking here at monthly down candles, A, B, C. Again, this is a very complex wave 4. This is the path I was looking for since pretty much 2021. You can see how long it can take for a correction to get completed, and we should now be in wave 5. Also, this one supports the notion we need another leg higher. That would then complete this whole rally, 5 waves up of the March 2020 low. Perfect. I like it. This is then the semiconductors. This is the most bearish count I can come up with, 5 waves lower. Don't like it too much. My preferred wave count remains this. Here I can still think of another leg lower as a ending diagonal wave 5 of C04, but it is not necessary. Okay. We definitely fell short. The wave 3 should have been here. Wave 4, wave 5 should have, meaning following an ideal standard Fibonacci pattern. Semiconductors didn't. All right, it happens. Okay. The other ones really did get very close. We didn't get the 3 and 4 I was anticipating, but we did bottom in the wave 5 of C target zone exactly. Right, the ideal downside target for the Nasdaq 100 was 13,115 to 13,111. We got 13,065. Doesn't get any closer. Now let's look at how oversold the market has been. This is the S&P 500 daily chart going back to 1980. This is the MACD. All right, the MACD has not been below 75 more than 3 occasions prior. March 2020, 2018, 2008. And that's it. We've not had a MACD below. Now we almost went to minus 100. What did the market do? Got very close to a bottom in a massive bull market. We bottomed, and of course here we bottomed as well. That was, of course, extreme. Why was the MACD reading in March 2020 so extreme? Because it went so fast. But again, it shows 3 out of 3 tell us that we have a good run ahead of us. That is what this tells us. 3 out of 3. Okay, I like it. Just wanted to show you how oversold the market is. Then we're going to zoom out on the S&P 500 as well. And we can see we bottomed right here in this ideal wave 4 target zone, the black one. Looks good. 1, 2, 3, 4, 5. I'm fine with this. So nothing has changed my conviction that we have completed wave 4 and we should now be in wave 5 to S&P 6,000 plus or minus 300. Make it S&P 500, 5,500 plus or minus 500. We'll narrow it down, but I think 6,000 looks good. 1, 2, 1, 2. Very nice wave 3 extended. See, the S&P 500 is slightly different from the Nasdaq, and I think we have a nice completion. And simply put, as long as we can hold this week's low on Thursday, I think we can go off to the races. Here is then the short-term wave count I presented as one option, that we only completed 3 and then 4 and then 5, 3, 4, and 5. This one's off the table. This option is off the table. Why? Because we've gone way above this wave 1 level. Not going to happen. So I'm not even going to deal with this one anymore. Then the next option is that are we in 3, are we in 4, and then in wave 5? No, we've now overlapped with this one as well. So this one is off the table as well. So what we have left is then another option, that is that we have completed all of wave C of wave 4. This is a slightly different wave count, as you can see, but it is the same. In the sense that we have the same resolution. Wave 4 has completed. This is more analog the Dow Jones and less analog the technology sector. So we have A, B, C. You can make it 5 waves. It's fine. A, B, C. Correction completed. What matters is this A, the B, and the C. We're not going to get ourselves too hung up on the intricate details of this move. The B wave could also have topped here, and then this was a 5 waves C wave. It's all nice and dandy. The bottom line is that we most likely have completed wave 4. Another line of evidence is that we've now finally had a over 10% correction in the S&P 500, which happened the last time in September 2020. That was an almost 11% correction, and we haven't had one in the S&P 500 since. Well, this kind of adds flavor to the idea of, okay, now we have at least 2 corrections. So the first one is then wave 2, the second one is wave 3, and now we can go to wave 5, of course, because everything in between was wave 3. So this adds weight to the evidence that wave 4 has completed. Let's look at the IWM, the Russell. I was looking for a low at 188 ideally. So the wave 5 of C of 4 target zone was here. And instead of subdividing, we ran right there on Thursday. On the news, of course, that Russia had invaded and started a war with Ukraine. Look what we got, right smack in this target zone. These ones are more important, ultimate downside target zones. Very close to the ideal blue wave 4 target zone, nicely in the ideal black major wave target zone, perfectly in the minor, perfectly in intermediate. So we have 1, 2, 3, 4 levels of fit confluence, all pointing to the same notion. So then we can update the wave count, say topped here for wave 4. This was the ideal wave 5 downside target, this red arrow. Then we had a wave 3 here. We had a wave 4 here. And then this was wave 5 of 5 C of 4. And I am absolutely fine with it. Look at the rally we've had since. Okay. So I simply missed, so to say, the last little scribble where we got all this fib overlap, which is what matters. The green one, the red one, right? And right at the 123.6% extension of wave A, measured from wave B, for, in my humble opinion, a picture-perfect zigzag. 5 waves lower for wave A, 3 waves higher as a irregular expanded flat wave B, 5 waves lower for wave 5 of C, for wave C of 4, sorry. So I like it. I am fine with it. Let's look here where wave 5 of 5 bottoms, again, right in these ideal target zones. It doesn't get any better than this, and we get a very strong reversal from it. That is a good sign. Look at all this positive divergence that's going on that I warned about, or not warned about, but tell you we were tracking. Look at this, what the MACD is doing. This looks good. It doesn't get any better than this. If we now fail, it will be a total disaster. I don't think so. Why? This is the bigger picture count. And besides that, we stepped below the 191 level a little bit, right in the wave 4 target zone. We should now be on our way from 5. I remain convinced, I'm not convicted, I'm not a felon, of this wave 5. We need to break below 180. Okay, then I'll start changing my tune. Until then, I'm going to look higher. Let's look at market breadth. So a lot of charts to cover. What we now have, again, are in the buy level, and we got a reversal from below 30 to over 30. Besides that, we now also have nice little positive divergence here going on, friends. This looks fantastic. Look at this. Fantastic positive divergence. As you can see, negative divergence takes a long time before it finally matters. Positive divergence on these type of indicators is often much faster responding. So that looks good. All right, that looks good. So this is the bullish percent index for the Nasdaq. Again, supports an important low. Bullish percent index for the Nasdaq 100. We have similar lows as we had in January. This also looks great. Again, a vertical line there. As you can see, this looks good. And we have pretty much similar lows while we have a lower low in price. I like it. This is very suggestive of an important low being in place as well. Let's look at the McClellan oscillator of the Nasdaq. Massive positive divergence, as you can see. We already had a little bit of divergence earlier on in January, but now we have massive positive divergence there. Compare that with here. Okay. Similarly, we had it earlier on, here, for example. And what did we get? A big rally. Okay, so that is good. I can show you other examples as well, where we had some positive divergence here, or sorry, this one, etc., etc. So this is good. Positive divergence is always a strong indicator. How are we doing for the Nasdaq 100? Same here, positive divergence. On the McClellan oscillator, it dipped once again into the buy zone. I like it. Again, another line of evidence that tells us that we should look for higher prices and not for lower prices. Let's go to the new lows versus new highs. Okay, this is actually new lows. New lows are now calming down. Look at these massive spike highs that we had for quite a while, and they always go inside with being close to a bottom. Here, close to a bottom, close to the bottom. And now if we can stay below 50, even 100, I'll be fine with this having subsided. The final washout low has been reached. So this is very important as well. How we're doing for the McClellan oscillator for the S&P 500, also here, of course, again, positive divergence. Positive divergence is a much stronger reaction, I would say, than negative divergence, which I showed you can last for a long time. Look at that. I like it. This is classic. It really adds weight to the evidence that we have struck an important low. Now let's go to sentiment. As on Wednesday I said, let's review some sentiment indicators. Here we are at active money managers, and they are under leveraged. Right? Again, we are now close to where we can expect important bottoms to happen. Right? It's quite canny how that works, and nothing's too extreme, as you can see, but often when we go below 50, it is a nice buying opportunity. It's nothing too extreme, but that's fine. Why are the active money managers maybe not that exposed? Let me show you. This is a chart from Larry Williams that shows you the commercial traders. Commercial traders are banks, mutual funds, corporations, institutions, maybe even government, which are massively long the futures market for the S&P 500. More long than they were actually in March 2020. More long than they were in 2018 or in 2019. Yes, there is a failed reading here in late 2018, but again, the longer term was massive gains. Instead of focusing on the one failure, focus on all the times it is correct. It was correct here, it was correct here, it was correct here, 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 here. Every single time it's been correct. So 1, 2, 3, 4, 5, 6, 7, 8, 9. With 10 occasions, 1 is wrong, 9 are correct. That's something you don't want to bet against. So that is a good sign that we are in a positive market environment now for a rally. Right? It's the contrarian stuff we're looking for. Let's look at the VIX. This is the VIX divided by the 3 months out volatility, and it topped over 1. And often when it tops over 1, we get very close to an important bottom. I like it. Let's look here at AAII individual investor sentiment survey. This was we were looking for massively bearish. This is very, very bearish. It's the highest reading in 1 year. Contrarian in us tells us, okay, the retail investors are once again on the wrong side of the trade. Commercial investors were on the right side of the trade. The commercial investors, the big boys, are big for a reason, because they're most often on the right side of the trade. We just determined in 5 years, 9 out of 10. Retail is 9 out of 10 times on the wrong side of the trade. Once again, too bearish. Again, it's of course a survey, doesn't say anything about allocation, but when you are this bearish about the market, most likely you're not going to invest in it. But it just shows you, contrarian, we're doing great. I like it. Let's look at Twitter sentiment. Also, this one, I think it's a very interesting reading. Shows us too bearish. Twitter is too bearish, almost like World War III is coming, all that stuff. I've repeated it so many times. Remember, the market bottomed in early 1942 and rallied until pretty much when the Second World War declaration of defeat for the Germans was signed in May 1945. Then the market almost crashed after that. It's doing the exact opposite of what you would think it would normally do. I believe the reason is because we had Pearl Harbor in early December 1941. Early May of early 1942, I think the markets realized now the United States is massively involved and we have a winner. The market will pick a winner and rally 150%. So we might see the same here now for the Ukraine-Russia invasion. Okay? Because if we look at how markets behave, this is a tweet by Tom McClellan, wars are usually bullish, okay, but the descent into war is bearish. Okay, so this is again, we initiate the downside for the initiation of the war, but eventually when the war gets going, it is bullish. That has been confirmed by another tweet where it shows by the invasion. This is the Vietnam War, the Gulf War, the Afghan War, the Iraq War, the Crimea crisis. Every time you buy the invasion, the market will do pretty well. Yes, we are in some bear markets as well, but you can see the general trend after the invasion is higher. Now the market has priced in the whole escalation of the conflict. How bad it is and how unfortunate it is, all those things aside, it has priced it in. So now it's forward looking. Just as it bottomed 2 weeks after the pandemic was declared in March 2020, it is forward looking. Just as it was in 1945 when the whole world is at war, it is forward looking. So now this has been priced in and it's looking forward to a resolution of the war, which will be resolved one way or another. And the market has most likely picked a winner, and that might not be Russia. So we'll have to see how it transpires. But again, the bottom line is that wars can actually be bullish for the markets because it's looking forward to the winner. Back to the Elliott wave count. This is a tweet today by Zachary Manes from ElliottWaveTrader.net, or their subdivision stock waves. He is looking for 5 waves higher. I believe it was from the lows, and also thinks we have bottom for wave 4. You might get a B wave bounce and another leg lower. That is always possible, but I don't think that is the case. I agree with the fact that we have a wave 4 completed. And here he sees easily 5 waves up of the lows. All right. Again, wave 4 low. It's really counting it as 5 waves up. I'm not so great at the micro counting, so this supports that if we have 5 waves up on our way, then we are in a new bull market. It can be an A wave of a larger B wave that will consist of a 5-3-5 setup, but I don't believe so, based on all the other evidence that I've seen. Here again, this is also sentiment, how extremely bearish we are. Every time this reading goes below 0, we are at very important highs. Okay. Again, the run to 6,000, 18, 20,000 on the Nasdaq, and all the 40,000 plus on the Dow Jones won't be easy. We'll subdivide into 5 waves and all that good stuff. But the bottom line is there's so much evidence that tells us that we're getting very, very close to an important low. The price tells us that. And wave-wise, price-wise, there's enough scribbles in place to consider it complete. Sentiment-wise, market breadth-wise, all those good things. So we have so many lines of evidence to tell us that the bottom is in. I don't think I have many more charts to share with you. It's plenty. It's a lot of work. So the bottom line for today is, I don't think it is the 24th, it's the 25th. Sorry about that. Last week, I was looking for this wave 5, wave C, of wave 4. And that was correct. I was tracking the smaller 3rd, 4th, and 5th waves, grade 3, grade 4, grade 5. And we got pretty much all of that on Thursday at the lows. We reached all the ideal downside target zones for these smaller waves, 4, 5, and 5 and 5, etc. Okay, so all the downside target zones I presented on the charts have been reached except maybe for the semiconductors. Okay, well, got that one that may be wrong. Oh boy, can't get them all right? So now the indexes must break above last week's highs, not this week, last week's highs, as I showed you, to negate any further downside setups. And I said on Wednesday that on Friday we'll see how bearish sentiment really is. Well, it is very bearish. We just saw it. Individual investors are too bearish. Meanwhile, the commercial traders are extremely bullish. You know the outcome of that. I was tracking potential positive divergence of technical indicators, market breadth, all those things. Well, we have a plethora of positive divergence on these indicators. So my main conclusion is that as long as we can hold yesterday's lows, wave 4 is complete and we can go to our new all-time highs upside targets. That is all I have for today. Sorry again about the technical difficulties. They sometimes happen. I'll try to figure them out, see what's wrong on my end. Thank you so much for listening. I hope you appreciated this long but detailed story on why I believe wave 4 is complete. As long as we hold the lows made yesterday, we're good to go, in my humble opinion. This is as good as it gets from all levels of analysis. Price, market breadth, sentiment, previous patterns. Can't get it any better than this. So let's see if the market wants to comply. Take care, trade safe, and I see you all on Monday. Bye.